So today we'll be discussing about Reserve Bank of India, its establishment and its functions and its role in the economy. So just let's get started. Well, the Reserve Bank of India is the apex or the central bank of the nation. Okay, it was established in the year 1935 by the Reserve Bank of India Act 1934, established in 1935 by the Reserve Bank of India Act 1934, and it was nationalized in the year 1949. So during its establishment, it was not a nationalized bank. It was established in 1935, but it was nationalized in the year 1949. So it became a government body in the year 1949. So what are its functions? The RBI has various roles in the nation. Number one, it decides and manages the monetary policy of the nation. Okay, like what? Like increasing or decreasing the liquidity of money in the market, deciding about the interest rate, whether to bring it down or make it go up. Number two, it is the bank of the government. Just like we deposit our money in the commercial banks, the Reserve Bank of India is that bank for the government. The government had its account in the Reserve Bank of India. So the Reserve Bank of India is the bank of the government. Number three, the Reserve Bank of India is the banker to the banks. That is, the commercial banks. Okay, the commercial banks looks after the RBI, looks up to the RBI for its policies and its deposits, whether they are running short of money, then borrowing the money from the RBI. Okay, so it's a banker to the bank. Number four, the RBI also manages the foreign exchange for the nation. Okay. Number five, issuing currency, except the 1 rupee note and the 1 rupee coin. The 1 rupee note or the 1 rupee coin is issued by the government of India and not by the RBI. So we'll discuss more about the monetary policy. The macroeconomic monetary policy is decided by the RBI. We have heard about the topics such as SLR, CRR, repo rate, reverse repo rate. So we'll discuss in details about these things. The macroeconomic policy of the government of the RBI is like decreasing the liquidity or increasing the liquidity in the market depending upon the economic situation in the nation. So suppose at this current situation where we are running short of money because the business has gone down, the market is going low, and we need a more amount of liquid money. So the RBI has decided to cut down the rates and increase the liquidity in the market. So what are the rates? We'll discuss about the rates. The first rate is cash reserve ratio. What is CRR? The cash reserve ratio, the CRR, is the percentage of the total deposit of the bank that the bank keeps with the RBI. It's in pure cash and the bank keeps it with the RBI. The CRR stands at 3% at present. Okay. Second, repo rate. Repo rate is the rate at which the commercial banks borrows money from the RBI. So when we are borrowing money from someone, we pay them interest. The same, the commercial bank borrows money from RBI and pay them interest. That is known as repo rate. The repo rate at present is 4%. Okay. So when bank needs money to extend credit or give loans, they borrow money from the RBI. That is repo rate. The reverse thing is reverse repo rate. When the RBI decides to cut down the liquidity in the market or absorb some liquidity from the market, okay, it takes back money from the commercial bank and pay them interest. That is known as reverse repo rate. So the RBI takes money from the commercial banks and pay them interest. This is reverse repo rate. It currently stands at 3.35%. Okay, the repo rate, commercial bank borrows from RBI. Reverse repo rate, RBI borrows from the commercial bank. It's like when RBI wants to cut down the liquidity in the market. Okay. Next is SLR, statutory liquidity ratio. SLR. The SLR is another form of tool that the RBI uses to control the credit that is created by the commercial banks. SLR is generally kept in the form of gold, cash, government securities, etc. The SLR at present is 18.50. SLR, the statutory liquidity ratio, is kept by the bank with themselves. Okay, in case some unforeseen situation arises, they make use of these resources: the cash with themselves, the gold they keep, and the government securities. Okay. Next is bank rate. What is bank rate? Bank rate is the rate at which the RBI lends money to the commercial banks or to other financial institutions or to the government for long term. Okay, the bank rate differs from the repo rate just in one case, that is repo rate is a short term instrument, but the bank rate is a long term. The bank rate at present is 4.65%. So what are the tools that the RBI uses? Cash reserve ratio is the money the commercial bank keeps with the RBI. Repo rate, the money that bank borrows from RBI. If the repo rate goes high, that means the bank cannot borrow money from the RBI and hence cannot lend more loans. Hence, the RBI cuts the liquidity in the market. The opposite thing happens in case of reverse repo rate. The reverse repo rate is the rate at which RBI takes money from the commercial banks. When the RBI thinks that the market needs more money, okay, so they bring up. So decreasing the reverse repo means the commercial bank will now not lend to the RBI, but they will have much more credit in the hand to give us loans like home loans. So the reverse repo rate and repo rate generally decides about the home loan interest or the car loans, etc. So these are the tools that the RBI uses for controlling credit in the market. Thank you.